Well, that's a lot better. Again, we started off this week almost exactly the same way we started off last week, with a big opening gap to the downside after Sunday night, big rally intraday on Monday, filling in the rest of the gap on Tuesdays. So, but there's very similar technical patterns to what we saw last week as well, especially on the market forecast. I'm going to break that down to see, okay, what do we expect to see now going into the rest of this week? What will we need to see from the markets to be able to not repeat the end of the week patterns that we saw? Now, granted, Friday's pattern was more bearish because of the news that ultimately impacted the market this Monday morning. But that's the kind of market we're in, and I'm going to kind of break down why the market may be leaning towards more of a repeat than not. So we'll break that down in today's video. What's driving this action, like in the major asset classes and sectors? We always talk about our sector rotation, the breadth. We'll break that down and kind of use that as a gauge as well to see whether or not we're going to get a repeat of last week or not. So we'll take a look at that, and then we'll take a look at our trade idea in a kind of financial tech area that really did not do so well, which might be a sign of things too. But we'll break down how to trade that with our trade idea tonight. So let's go ahead and get started. Today is Tuesday, February the 4th, 2025. This is the market outlook from marketscholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at marketscholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live videos, where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. We also put on today's trade idea already before the market closed here. During that, you just click on this image to get there, or come up to the top and go to the live trade review there. Come down to the bottom, click this heart. It opens up this tab. Hit that like button. Same thing here. Click the thumbs up icon. It opens up this tab. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with 1 or 2 really easy clicks. All right, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicators. You can see the nice little rally we had today, up 0.75%, closing above yesterday's high point, continuing, pretty much finishing, filling in the gap that we had on Monday morning. But here's the issue, just very similar to what we saw last Tuesday, right? So we had the Monday gap, and then last Tuesday, you can see the intermediate line was falling, but at least it was still above the 80th percentile and still above market sentiment. The momentum line jumped up, but didn't get into the reversal zone. The near-term line jumped above 40, barely, because it was barely below 40 there. Jumped up above 40, but didn't get above 50. So we talked about the prospects then, at least in our classes, of a bearish near-term peak developing. Well, that's the exact same pattern we have now. It jumps above 40, but not above 50 or 60 as well, right? You ideally like to cross 2 lines. The momentum line is above it, but it's barely above it, just like it was over here, and it's not above 80. It's not even bullish territory, so it's actually worse than this one. This time the intermediate line's falling, but it's below the 80th percentile, so we're actually worse in that situation too. So we really, really need a good day tomorrow to offset. I mean, I don't expect that we would, but of course that doesn't mean it won't happen. And if we do get a really good day today, that's what we'll need to really kind of offset this, because again, that's what happened last Tuesday. It was very similar, right? Very, very similar. And then we didn't get a good day on Wednesday. The momentum line dropped, and near-term line kept going up, but the momentum line dropped. And after one more day on Thursday, like, we didn't finish, like we formed the bearish near-term peak. So I don't know if it'll take all the way to Friday, or most likely tomorrow or Thursday. But the near-term line most likely will go up tomorrow. The momentum line, again, whether or not it continues to go up and gets up here, or whether it falls, will be this, how it will determine pretty much how far the near-term line does go up, and whether it will ultimately get up above the intermediate line and above the 80th percentile and start a new bullish run, or will it stay for a bearish peak underneath the intermediate line, and then now we're back to more bearish patterns. The moving average is rising, so we do have that going for us. And again, the intermediate line just needs to turn up, and it will be back to dark green shading. So just like that, we'll be back to dark green shading if we can build on today's rally with not like we did last Wednesday, but get another good day and probably close up here all the way up to the open of of last Friday. So that's kind of what we see there on the S&P 500. If you take a look at the NASDAQ 100, again, same thing. The momentum line's higher. It actually is in bullish territory this time. The near-term line barely crossing 40 and 50. See, this time it was barely below 40, so it barely got its toe up above 50 there with a 1.25 point rally. Intermediate line actually did turn higher, so we do have dark green shading and a green line, unlike the S&P. But again, we are set up for, unless that momentum line continues higher, if it reverses like it did last Wednesday, then it will keep the near-term line from being able to get up high enough into that reversal zone. The Russell 2000 actually had the best day out of everything, 1.25, almost 1.5%, but it still suffered the same pattern. It crossed above 40, but not above 50. Momentum line's higher in bullish territory, but not above the 80th percentile. The near-term line is still below the intermediate line. It's rising. We have dark green shading and a green line. So the intermediate line's rising and above market sentiment, which is different than the other indexes. But again, like last Wednesday, are we going to be susceptible here to a drop in the momentum line tomorrow or a continued run up to the upside? That remains to be seen. And then finally, your Dow Jones Industrial Average did cross below 40 and 50. It came from a lower level, crossed below 40 and 50, but again, your momentum line's barely above it. It's not even in bullish territory. Your intermediate line's falling, so this is kind of like what last Tuesday looked like without crossing the 40 and 50. You still have a strong bullish posture, but it's falling, and we'll see again. Are we going to be susceptible? I mean, this would be a very bullish intermediate low point. Like this was an intermediate confirmation signal. Obviously, we still fell yesterday despite the signal, but we rallied intraday and then continued higher today. So this should be a good bullish near-term bottom, right? And then we would expect that you would break through to new highs and get up to a pretty good high point. Otherwise, if we only get a small update tomorrow like this, below average range and below average volume, then we'll probably end up forming a bearish peak again, like we did on the S&P and the NASDAQ last week. We'll do that here on the Dow Jones, and again, that's the scenario you want to avoid. So I don't expect we'll have a strong update tomorrow, but if we do, that's what we'll need to break this weak bullish short-term sentiment and turn it into a much stronger short-term sentiment that would allow, in this case, the intermediate run to continue, because we've been dark green shading and green line for a while. But in the case of the S&P and the NASDAQ, it would be strong enough short-term sentiment to get the intermediate run started, right? To actually get a new one started there. Let's take a look now at the weekly chart. So we'll look here at this weekly chart, and again, you can see, as good as the first 2 days that we've had, again, coming off of the high point, it still is not strong enough. Your PPO is still falling. It's still a transition candle, and it's still bearish, right? We're still below, like the PPO or the size of the Hakinashi body, which is what you see here in green, is still easily below its average there. So that's kind of what we have going on. If you take a look at the 3 green arrow chart, you'll see that, again, we have 2 red arrows on the S&P, 2 red arrows on the NASDAQ, 2 red arrows on IWM. They haven't turned to green yet down there, but we are back above. Remember, when we get 3 red arrows, it's usually the moving average that bounces first, right? And we have that, on the Qs, we have that here on IWM, and of course, we still have 3 green arrows because we haven't got that red arrow on the MACD yet there. So we've still been on this bullish trend on the Dow, but the others, including the Russell again had 3 red arrows. Now, I only had a yellow line, but I had 3 red arrows yesterday. The NASDAQ was pretty close to 3 red arrows. The stochastics turned briefly green, but it was pretty close to 3 red arrows and a red line. So it kind of goes to show, how susceptible we are right now. If I take a look at, let's take a look at the 2-line version of the 3 green arrow chart. So we'll pull this up here, and you see again the close today got us back above the 17 and the 8-day moving average, and for that matter above the 50 clearly this time. And so we opened up Monday below all these moving averages. Same thing as last Monday, but in one day we're back above the 8-day, and one day we're back above the 8-day again. The MACD, however, unlike last week, the MACD is still below its moving average, so we're in convergence mode. The stochastics is also still below its average. You can see the volume really tapered off after 2 strong days of volume on Friday and Monday. Big drop in volume today. If I take a look at the DMI, you'll see again, because of the gaps, you have both lines above 25, which is uncommon, but your negative is still above the positive indicator. The ADX is falling rapidly as we don't have a clear trend going on right now. If you look at the RSI and the CCI, you see we did jump back above 50. So again, green line, we're able to keep the line green as a result of that because we jumped up above 50. Remember, once it drops below 50, then we're kind of halt the green to see if it drops below 40, and then we go back and turn it red. But in this case, we jumped back above 50, so we're still green. And we're, for that matter, still green here too on the weekly, because remember, it doesn't stop being green until we're in correction mode, because we're using the weekly chart here. That's when it stops turning green. And we're nowhere near minus 100. It's got to get below minus 100 for that correction to start, just like it did in 2022. And like it did here in the fall of 2023 when we were on the cusp of more of a correction, and we had kind of had a very, very weak correction and a really deep pullback there. But we're still on bullish mode here on the RSI. So we're on the same run that started with this intermediate rally, and this is currently our 4th intermediate rally that we've been on. Even though on the S&P, like you can see this last few days, we still really don't have, like we never really had dark pink shading and red line for very long, we've had dark green shading in the green line briefly, but obviously not right now, despite the fact that the RSI is still green. Let's look at the Ichimoku cloud, and you can see, we're back above the green line. We're still above the cloud. The cloud's still green. The rate of change is slightly positive. No trend here yet, but at least all signs are still pointed upwards there. When you look at like the diamonds, that's still looking pretty good. IWM, it's still got we're still below the cloud. We're back above the green line in the blue, but we're still below the cloud. The rate of change is positive, but we still have a weak bearish trend developing. So we need to break through. We need to follow up on this to break the trend that we have going on right now, the weak trend in this case on the Russell 2000. If I take a look at the Bollinger Bands today, the bandwidth is declining. It's pretty high, but it's declining as we're stuck right around the middle of the chart. The momentum is declining, so whatever bullish momentum we had to get us up to the top of the bandwidth, to get us close to that upper Keltner channel, we've lost it, and we're losing it, right? So that's the issue with the S&P, is that we're just, we're not strongly bullish, so we're losing momentum here. We did get a higher high and a higher low. We did close above yesterday's high, and like I said, we did finish filling in the gap there. That's pretty much all that we've done. However, we're still still don't have a new high point, so both lines are still continuing to fall as both tags are moving to the left. We're almost to the point where the low is over here, and once the low point gets to 0, then now we're susceptible, especially with the green line below 70, we're susceptible. Doesn't mean we have to. As you can see down here, the green line got to 50 before we got a new high, and the low eventually got to 0 after that. So it doesn't have to be the case, but we still are going to be very susceptible to a bearish breakdown, more of another intermediate decline here once we get, again, the green line below 70, and the red line, the 0 generally first, and then the green line below 70, and then we're susceptible to the breakdown as we saw right there. I showed you the volume today and trading range are both very, very minimal. Whoops. That's not the one I want to show you, this one. So very minimal. You saw the range was 5 points. The volume is 33 million shares down there. So the volume, again, the range 5 points is well below. It's down in here, well below the average. The volume, again, 33 million is below the 52-week average for the 20-day average. So we need more of these days. We're above the moving averages, so we need more of these days to stack on top so we can get this back below 1%. As of right now, we're still a little tenuously, volatile, right? We're right between 15 and 20. We're not back below 15 yet. We want to be below 15. We want to be below 90% here relative to the VIX 3M. We want to be below that 1% mark on the ATR, and we want to be below 100 on the VVIX, and we're right at 100. So, and we ideally want to be down on the skew. If you take a look at the skew, the other measure of volatility we like to look at here, we ideally want this to be below 150 because, again, we're more bullish when it takes off. Well, if it's already so high, it's hard for it to take off to get to a high point. I mean, even at like where are we at right now, 155? Even at 155, I mean, that's still a very high number in the recent past, last few years. That's still a very, very high number. So it's going to be hard for it to jump up from here. I mean, we just did that from a little bit lower than 155. But our bullish rally didn't last very long, right? As you can see, and we've already turned lower. So that's the problem with having the VIX. The VVIX still at 100 and the skew still itself at pretty decently high levels. So there's still a lot of fear in the markets for volatility, even though we're only not very far away from all-time highs, 1.33% away from all-time highs. All right, now let's go ahead and take a look at what's driving the price action today. Again, you can see the outperformance by the Qs in the past few months, but let's zoom in on what's going on today. So give me 1 second to pull that up, and you can see emerging markets really had a good day today. They're up almost 2%. And this is the biggest reason why. The dollar dropped big time today. Bonds started the day much lower, but then they rallied throughout the day, finished at their highs today. It wasn't very much of a gain, but it was when you count the opening gap to the downside. So pretty good move for bond yields down, along with the dollar being down. And then commodities you can see lagging behind at least all these different equity asset classes. That's all bullish. All three of those things are bullish. But that dollar move is the biggest move, right? That's the biggest deal here. If we take a look at the dollar index, which remember matches the futures contract here, you can see the move that we had. So this is starting today. So this is already tonight. This is the move that we saw yesterday, and you can see the big decline that we had there. Here, let's do UUP, and that will be easier to see. There we go. So there's today's move, right? Big down move to the downside, back below moving averages after failing up here. It's a significant drop, and you can see the post expiration adjustment here. But still a pretty significant drop there below these highs that it's had and failing again. So if I look at like the Euro US dollar, which is the biggest component of the US dollar index, again, this is the move that's currently making, and then that's Monday's move, and then now you can see the euro is close to getting back above its moving averages, trying to make another run above the 50-day. It's not quite there yet, but if it does make it run above that 50-day like it did here, then there's a pretty decent sized gap. In fact, one of your bigger gaps that we've seen between the 50 and 200-day moving averages for a while, right, is like back over here. But you can see here, like in 2021, when the dollar started to fall, or euro started to falter, it continued to falter down there. We're above the parity, so we were briefly below parity at the end of that move. We're currently above parity, so it's not like we're so extremely oversold that we have to go up. If I zoom out, so we can kind of see, like we briefly went below parity there, but back in when the other time that the market's been so highly concentrated, especially in the tech sector, the dollar was very strong there too. It got down to way lower than we're at right now. So just because we're barely above parity doesn't mean, and we're at pretty much at 20-year lows, doesn't mean that we are like extreme, like we can't go lower. So, and that's high. That means higher for the dollar. So that's something to keep an eye on to see whether or not the dollar will be able to reverse the course. The other biggest component of the dollar index is the dollar versus the yen. And again, you can kind of see how it's been doing. We'll zoom in. The dollar's dropped to the 200-day moving average. And again, a bigger drop on here would be weakness for the dollar and strength for the yen. Remember, the yen is even more of a safety trade than the dollar is. So in this particular case, weakness in the dollar against the yen is probably not the best thing, right? Because usually the yen is considered a safety trade. And then finally, your third biggest component of the dollar index is the pound versus the dollar. And again, same as the euro. You're sitting right there with the ability to get going to the upside, still sitting at that 50-day moving average. We failed there before, and we'll see if we fail there again or not. If we can break through, then again, weakness on the dollar would actually be very bullish for equities. Now, when you look at the 10-year yield, you see that it had a big down day today too, along with the dollar. And it's sitting here right at its 50-day average still. So again, we're either going to hold support and bounce. We're either going to hold support and bounce here, or sorry, I can't get this cough out of my throat. Or we'll break, right? And if we do break, the 200-day moving average is at the low end of the current Fed funds rate. And a break below that would be very bullish for equities as well. So whereas a bounce off of this and a continuation higher would be a reflection of higher inflation expectations, which would be kind of going in conjunction with what you're seeing here from crude oil, right? If crude oil has been sitting on its 50, so all of these are at very, very important levels. So a bounce off the 50 for yields, for the dollar, for commodities would all be bearish for equities, whereas a break in the wrong, in the better direction, the right direction, would be very bullish. In this case, breaking down would be very bullish for equities here. So very important levels all across the board, and ultimately that will have an impact on the rate cut odds. Because remember, ultimately we do not want the Fed to cut rates, right? We want those rate cuts to eventually be on the table, but we want to take the rate cuts off the table here for the next however many months, especially at least through the month, at least with our first cut being in June. You can see right now the odds of a cut, for from a week ago have gone from a month ago, have gone from 50% up to 80% of no cut in March. So very high odds of no cut. We've gone from 42% to 61% for no cut in May, and then June is kind of that important time where they probably could start to cut. And now we were at 40% odds yesterday. We're at 35% odds now. So again, the fact that we don't cut is what makes markets bullish. But as these cuts come off the table, that's what creates the volatility. But as long as we don't have to cut through the first half of the year after we get a period of volatility, then we have a very good chance of being bullish through the first half of the year and into September. I personally think their first cut, if they need to cut by the end of the year, right? Because that's a big if. We might not need to cut. But if they need to cut, I think their first cut will be in September. Right now at 20% odds, which is the same as it was about a month ago. Of no cut, right? So 80% odds of one cut. That's kind of where I'm thinking. So in the meantime, that means this has got to come off the table. That's going to move up to 100, which, again, that will create some volatility. That means yields will be rising. Most likely yields will be rising in that scenario. And since the 3-month and the 2-year won't be moving, because right now you can see the 2-year just isn't moving. This is the path of cuts or hikes for that matter going forward. It's as flat as a pancake right at the current levels. So as long as the 10-year keeps rising, that will make this rise. And when this rises, these spreads, when they rise, it's not bullish for equities. It's actually more bullish when they fall, because either the Fed is lowering rates raising rates, which is bullish, right? Ultimately bullish for the markets when the Fed is raising rates, because the economy is growing and doing well, and the markets can take them. Or the 10-year, if they're not raising rates, then the 10-year yield is just falling, which would be a good sign. Sign for the markets too, as long as the 3-month and the 2-year stay flat, right? As the 10-year falls and they don't fall as much, then that's another reason for these spreads to go down, which is, again, very bullish for equities. The Brent still isn't great. It wasn't too strongly negative. It had turned negative yesterday. It jumped back up today. It's still not very great. I'd like to get it back up above 35, but at least it's positive. So that's a good sign. If you look at the other breadth signs that we like to look at, like the number of stocks, the net new highs and lows, barely crossing below zero today, barely. But was at pretty strong levels yesterday, above 200. When you look at the new highs, below the average, but still, still pretty, relatively decently high. But the number of stocks above the 50-day moving average staying at decent levels, staying at least above 200, above the average, even if it's not quite above the midpoint or above 300. The ratio we pay very close attention to is still below its average, right, which is good for the markets when it's below its average. That's usually when things start to take off. We want to see that, right? We want to see it break its average and go down, and that makes the markets go up. The markets like that. What it doesn't really want to see, what we don't really want to see, is a break above the moving average and it to rise, and the average to rise here. So you can see the MACD looks like we're bottoming out, but as of right now, we're still okay on that. And if you take a look now at how the sectors performed today, obviously with the crude oil doing so well, you're going to have a big jump in the energy sector. But the other really good sector that had a pretty good jump today that actually matters a lot more is technology. Technology has been struggling, and the market really can't get going unless technology makes a run back up to the upside. And we were down below its averages. Now we're back up. If you look at the weekly version of this chart, you can see we're in the lagging category with both the relative strength and momentum lines there below zero. But if you look at the weekly version, we're also not doing so hot. We're well below the average here, the 50-week average on the ratio. We are almost in the leading category. The momentum has been above 100, but we're about to get relative strength above 100. But the problem is still, even with today's rally, last week we closed below the 17-week moving average, and so far we're trading below the 17-week moving average. So we really need to change that around and get that going to the upside, because it's really important that the relative strength of technology, considering that it has the three biggest companies, with others, that are pretty high, like Broadcom and others, Salesforce, other stocks as well that are in that space, both software and chip names. We really need this to outperform, get back above the 200-day. You can see the ratio, despite today's rally, is still below even the short-term moving average. The nice thing is the momentum is pretty negative, and so there's an opportunity that we might be able to bottom out here on this momentum and make a run to the upside. And a run in relative strength of XLK to SPY to the upside will obviously be bullish for equities here going forward. All right, our trade idea comes from actually it's kind of a technology company, but it's actually been placed in the financial sector, and that is PayPal. PayPal came out of its earnings with a significant move to the downside. Obviously has a red line, as we are well below falling moving average now. It's been falling for a while, but we've been above it, hence the yellow line. Now we are clearly below it, well below these old lows that we've had, all the way back to this bull tag low we had over here. 11% below the moving average, which is the biggest in the last year. And I think it's actually the biggest for quite a while. No, not quite. It's actually only the 30th percentile for the past 5 years. Back over here in 2021, going into early 2022, we had a big significant decline below that. But if you take a look at the intermediate line failing at the market sentiment, falling again, but almost back below 50. Near-term lines still can't get going, and momentum line dropping to extreme lows. Big decline there. If you look at the weekly market forecast, you got a bull tag, right? So this is clearly a bull tag, but a big drop to get to that bull tag. So again, it can either be the type of bull tag that bounces you up to the upside, or it starts your intermediate decline down to the downside. Your other weekly chart we like to look at, the Hakinyashii candle. Obviously, we have a pretty bearish candle here with a red arrow, biggest body on a bearish candle that we've seen in a while, right back when we're bearish. And we're flirting with the 40-week moving average already as it is. You can see the PPO is actually still in the 90th percentile of the past year. Excuse me. Sorry about that. If you take a look at the 3 green arrow chart, we obviously have 3 red arrows, right? That's pretty obvious here with a lot of volume. 3 red arrows with a lot of volume. If you take a look at the 2-line version, as mentioned, we broke well below the 50, working our way down to the 200. There's not a whole lot of volume where the 200 is, and not really until you get down to about 67.5 is where the next little shelf of volume support is. So if we can hold here at the value area, great, as well as, again, that bull tag on the weekly chart. But if it doesn't, then there's not a whole lot, besides the 200-day, there's not a whole lot of volume or support to hold you up until it continues to move lower there. With the MACD and stochastics, you can see just starting to move lower. Obviously, when you look at like the DMI and some of these other indicators, you're going to get breakout patterns all across the board, right? So well above 30 on the negative, below 20 on the positive. The ADX is just starting to rise. The RSI and the CCI broke down to significantly low levels. well below 100 and below minus 400 on the CCI. Well, and we went from being above 50 to almost being below 30 on the RSI. So significant move in that direction. The Ichimoku cloud, you can see, and it would be one thing if like we had gapped down and just kind of held here, but we started up and then fell throughout the day and closed at the low of the day, and that's kind of what makes it. You can see the bearish trend hasn't even developed yet. Like we've gotten to zero on both these lines, but we had, because we were kind of very, very weakly bullish, like to the point we weren't even above 50 here, or above the 1. You have to be above 1 and above 50 to have a weak trend developing. So pretty clearly bearish there, and well outside both the Bollinger Bands and the Keltner channels. You can see to the downside here, big breakdown. The bands themselves are just starting to rise from very low levels. The bands were about to cross it. Well, they did. They did cross. They weren't crossing it during the Market Outlook Live, but now they have crossed outside. We have the green dot, and you can see the momentum has gone from pretty decently positive to now slightly negative. So we're kind of just getting going here potentially on this move. So what I decided to do is to do a long put vertical spread for, let's see, it's for March expiration. Looks like the trade didn't fill. Didn't fill for me. Oh, here it is. Sorry, I'm in the wrong account. If you take a look here at the PayPal, there we go. There's our trade. You can see I did the low 20s on the delta. So we sell the 90, bought the 92.5. There's the trade. The maximum gain is about 3.5 to 1 reward to risk ratio when I position size for the $500. There's the move. So it's pretty aggressive. Remember, 67.5 is where that shelf of volume is. So if we get going more to the downside, I get a good return. I get very little risk, even though it's the same $500, but my risk is actually defined by how much reward I'm going for. So very little risk for the reward that we're shooting for on this trade. If it follows through on this decline and continues to move to the downside, again, as it did pretty much throughout most of the day today. You can see, if I take a look at the intraday chart for PayPal, you can see how it started off a little bit of a dead cat bounce, and then we just kept going down throughout the day, which is way worse than just if we kind of drop down and just kind of stay down here for most of the day. Then you'd have a pretty good chance at actually bouncing and filling in that gap. Not a very good chance at all of filling in that gap now, considering how far away from it we are, and more likely that we might build on that. At least that's the premise of the trade. It doesn't mean it will happen, and if it doesn't, then we'll take a small loss on this, considering what we're trying to make. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody, and we will see you all tomorrow.